15-year versus 30-year. You're sitting there looking at two pre-approval letters, terrified that picking the 30-year makes you financially irresponsible, but picking the 15-year is going to make you completely house poor. And the frustrating part is every finance video you've watched disagrees with the last one. Dave Ramsey says 15-year only, always no exceptions. Graham Stephan says 30-year smarter. The money guy says it depends on your age. Your lender doesn't care. They'll approve you for whatever you can technically afford. So let's settle this. By the end of this video, you'll have a clear framework based on your situation, your income stability, and where you are in life to make this decision with confidence. We'll run the real numbers, show you which buyer profile matches your situation, and give you a conditional verdict, not a one-size-fits-all answer. This is educational content, not personalized financial advice. $249,000. Not from picking the wrong stock, not from missing a market run, from one checkbox on a mortgage application. 15-year versus 30 years on a single $320,000 loan. That's the difference in total interest paid over the life of the loan at current 2026 rates. Your exact number will vary by lender and when you lock, but the order of magnitude won't. Let's start with the basics because there's one thing most videos skip and it changes how you think about everything else. A mortgage is a loan. You borrow a lump sum to buy a home and agree to pay it back over time with interest. The term is simply how many monthly payments it takes to get to zero. A 15-year mortgage, 180 payments. Higher required payment, lower interest rate, done in half the time. A 30-year mortgage, 360 payments, lower required payment, higher interest. You're paying the bank longer, and for that privilege, you pay a higher rate. Here's the actual math on a $320,000 loan. That's a $400,000 home with 20% down at current 2026 rates, roughly 5.8% for a 15-year and 6.5% for a 30-year. The payment difference is roughly $600 per month. That's the number at the center of this entire debate, because that $600 is either a burden that makes you house poor or an opportunity to invest somewhere else. Let's go head to head on the 5 things that actually matter here. First thing, interest rates. The 15-year wins every time. Lenders charge less because their risk is shorter. The current spread is about 0.65 percentage points, which sounds small, but multiplies across the full loan balance for years. Secondly, the monthly payment. The 30-year wins. $600 less per month buys breathing room. For most middle-income households in 2026, that's not nothing. That's a car payment, a kid's activity, a month of groceries. Thirdly, total interest paid. The 15-year wins by a lot, around $249,000 less on a $320,000 loan. Not a rounding error. The reason is because you're borrowing at a lower rate and paying it back in half the time. So the compounding works in your direction. Fourthly, equity building speed. Here, the 15-year wins by lot. After 5 years on a 30-year mortgage, you've paid off roughly $20,000 of a $320,000 loan. On a 15-year, you've paid off around $77,000. That's 4 times more equity in the same time frame. Now, here's the one that surprises most people. Flexibility in a crisis. The 30-year wins, and this might be the most underrated point in the entire video. A 30-year mortgage gives you a contractual floor. Your minimum obligation is $2,024. If you lose your job, have a medical emergency, or your income drops, you can still make that payment while you figure things out. With a 15-year, your floor is $2,600. That $600 difference can be the difference between staying current and going into default. You cannot uncommit to a higher minimum payment when life happens. So here's where the current debate actually lives. The 15-year is cheaper to borrow and cheaper in total. The 30-year is cheaper every month and safer in a crisis. Neither answer is wrong. The question is, which trade-offs fit your life? Before we get to the investing argument, 2 alternatives worth knowing about. First, the 20-year mortgage. It sits between these 2 options on both payment and total interest. If you can afford more than a 30-year payment, but a 15-year feels like a stretch, ask your lender for a 20-year quote. It's underused and often the right answer for people who feel caught in the middle. Second, the 30-year with voluntary overpayments. Paying the 30-year minimums but adding extra principal whenever you can. We'll cover exactly how that works in the scenario section. For now, let's cover the investing argument. Now, let's talk about this because you've definitely heard take the 30-year and invest the difference. The idea is that instead of locking that $600 into a 15-year mortgage payment, take the 30 years lower payment and invest that $600 monthly into the market. The historical S&P 500 average is roughly 10% nominal, so the investment returns will beat the interest you're paying on the mortgage. Here's what that looks like on paper. Running $636 a month at 7% annual return, monthly compounding, a conservative long-run assumption for the full 30 years on the 30-year route, and for 15 years after payoff on the 15-year route. At year 30, the 30-year borrower who faithfully invested every month ends up with about $780,000 in investments, on top of their now paid off home. The 15-year borrower, who finished paying in year 15 and then invested their full $2,600 payment for the next 15 years, ends up with actually $870,000. The difference is real but smaller than you'd expect, and here's why that matters in 2026. In 2021, when mortgage rates were nearly 3%, this argument was almost a slam dunk. Borrowing at 3% to invest at 7% is a 4% spread. You're almost certainly coming out ahead by investing the difference. Today, 30-year interest rates are at 6.5%. The spread between your mortgage rate and expected market returns is much narrower, and the market doesn't always return 7%. Some years it's down 20%. A guaranteed 6.5% return from paying down your mortgage starts to look a lot more attractive compared to a volatile equity market. The invest the difference strategy still works mathematically, but it requires two things that are harder than people admit. First, actually investing that $600 every single month without fail for 30 years. Behavioral finance research consistently shows that most people who intend to invest the difference don't follow through over a full loan term. The cash gets absorbed by lifestyle, emergencies, and inertia. Second, you have to hold through market downturns without panic selling. The strategy only works if you stay in. The bottom line on invest the difference is if you will actually do it, and if you can stomach the volatility, the math is close. 30-year plus disciplined investing is competitive with the 15-year route. If you know yourself and know you won't follow through, the 15-year is forced savings. It works on autopilot. Now, let's get specific. Here are 4 real profiles and a clear answer for each. Profile 1, the early career buyer. You're 27, income is solid but growing, you have student loans or a thin emergency fund, and you're probably not going to be in this house forever. The right call? 30-year. Here's why. In your 20s and early 30s, your most valuable wealth-building asset isn't your home equity, it's time in the market. A $636 a month difference invested in a Roth IRA or 401k from age 27 compounds into dramatically more than the interest you'll save on the mortgage. You also don't have the emergency fund cushion to absorb a $2,660 minimum payment if your income dips. And if you're putting less than 20% down, which most first-time buyers are, PMI adds to the monthly burden on either loan. The 15-year does eliminate PMI faster, but that advantage doesn't outweigh the flexibility risk at this stage. Take the 30-year, keep your payments manageable, invest the difference, and actually do it. Profile 2, the disciplined mid-career buyer. Now you're 38, income is at or near peak. You've got 3 to 6 months of emergency reserves, you're already maxing your retirement accounts, and you're planning to stay in this house for 15 plus years. The right call? 15-year. You can handle the higher payment. Your retirement accounts are funded, the 15 years forced saving mechanism is adding real equity to your balance sheet, and you'll enter your peak earning years at 50 without a mortgage. That's a massive reduction in required retirement income. This is exactly who the 15-year was designed for. Profile 3, the variable income earner. You're in sales, freelance, or commission-based work. Good year, you handle either payment. Bad year, you need breathing room. The right call, 30-year, but treat it like a 15. Take the 30-year for the lower contractual floor. In good months, voluntarily pay the 15-year equivalent. Add $636 extra to principal. In slow months, revert to the 30-year minimum without default risk. You get most of the 15 years benefits with a built-in safety value. Basically, have a plan, have a backup plan, and don't tell the bank which one you are on. 1. Profile 4, the pre-retirement buyer. You're 52, buying or refinancing, and your goal is to enter retirement without a mortgage payment. The right call, 15-year, if it aligns your payoff date with your retirement date. At this stage, entering retirement debt-free isn't just psychologically satisfying, it's financially transformative. Here's the math. If your mortgage payment is $2,024 a month, that's roughly $24,000 a year in income your retirement portfolio no longer has to generate. At the 4% withdrawal rule, eliminating that need means you could retire on about $600,000 less in savings, or retire several years earlier on the same balance. The 15-year gets you there. Just confirm your retirement accounts are also on track. Don't sacrifice the portfolio to pay off the house faster. The goal is both, not one at the expense of the other. Take Maria at 52, refinancing into a 15-year at 5.8%. Her loan ends at 67, the same year she wants to retire. Her mortgage payoff date and her retirement date are the same day. That alignment is worth planning around. Before we get to the criticisms and the verdict, here's the moment I want you to actually do something. Pull up your mortgage statement or your lender's loan estimate. Find the first month's payment breakdown. It lists how much goes to interest and how much goes to principal. If you don't have a statement yet, open up any mortgage calculator and enter $320,000 at 6.5% over 30 years. And look at month 1. You'll see roughly $1,700 of your $2,000 payment going to the bank as interest. Only roughly $300 reduces what you actually owe. On a 30-year mortgage in the early years, roughly 75 to 80% of your payment goes to the bank as interest. If your payment is $2,000 a month, only about $300 of it is reducing what you actually owe in the first month. If that number hits different than you expected, that's the point. The question isn't which loan sounds better, it's how much longer are you comfortable paying the bank before you're paying yourself. Now, I want to share something that might complicate everything that I just said. The most honest critics of the 15-year mortgage aren't saying it's a bad product. They're saying it's the right product for a smaller slice of people than its promoters admit. Dave Ramsey will tell you the 15 years is the only acceptable choice. He's not wrong about the math. He's right that most people who say they'll invest the difference don't follow through. But his advice implicitly assumes you have stable income, a fat emergency fund, and no other high priority financial goals competing for that $600. For the median first-time homebuyer in 2026, stretched by elevated home prices and 6.5% rates now, those conditions often don't hold. Graham Stephan made the famous case for the 30-year, and he's right that for some disciplined investors with a long runway, the flexibility and potential investing upside are real. What he's less explicit about is that his audience skews high income and financially engaged. Invest the difference is great advice for someone who will actually invest the difference. The Money Guy show probably gets closest to the honest answer. The right term depends on which life stage you're in, how stable your income is, and whether your retirement accounts are already on track. Their life cycle framing is better than always 15 or always 30. The criticism that all three camps share is they often treat this as a static decision, made once and held forever. The average American moves or refinances every 5 to 7 years. If you take a 15-year mortgage and sell in year 6, you captured some of the faster equity build, but you also paid a higher required payment for 72 months. That trade-off only makes sense if you actually stay. If you're buying what you genuinely believe is your long-term home and your finances can support it, the 15-year is a strong choice. If, however, there's meaningful uncertainty about how long you'll stay, the 30-year gives you more options. Comment below, are you going 15 or 30, and what's your age? And drop it below because the range of answers always surprises people. Now, these are the 3 mistakes I see most often, and none of them are about picking the wrong term on paper. Mistake 1, evaluating the loan by total interest and stopping there. You look at a calculator, the 30-year shows $408,000 in interest. The 15-year shows $159,000. The math looks obvious, but that calculation assumes you hold the loan for the full term, 15 or 30 years. Most people don't. They move, refinance, or trade up within a decade. If you sell in year 7, the relevant number isn't $408,000, it's how much interest you paid in those 7 years versus the 15-year and whether the $600 a month difference could have been better used elsewhere. Run the math for your actual expected timeline, not the full term. Mistake 2. Refinancing from 30 to 15 too late and at the wrong moment. Here's one that costs people tens of thousands of dollars and feels like a smart move when they do it. You've been in your 30-year mortgage for 8 years. You've built equity, rates have shifted, you decide to refinance into a 15-year to finish strong. The problem, you've just spent 8 years in the most interest-heavy part of your original amortization schedule. Now you're refinancing your remaining balance and restarting a fresh front-loaded amortization curve on a new loan, plus closing costs, typically $4,000 to $8,000 out of pocket. In many cases, you'd have been better off simply making extra principal payments on your original 30-year than going through a full refinance. Before you refinance into a 15-year mid-loan, run the full cost comparison, including closing costs, not just the new payment. Mistake 3, the one that costs the most, not making the decision at all. This sounds obvious, but it isn't. The most expensive version of this decision is accepting whatever your lender puts in front of you without shopping or comparing. Studies consistently show that borrowers who get only one mortgage quote pay meaningfully higher rates, often 0.25 to 0.5 percentage points more. On a $320,000 loan, an extra 0.5% rate costs you roughly $38,000 over 30 years. That's a bigger dollar mistake than the wrong term choice. Shop at least 3 lenders. Compare the same term on all 3 before comparing terms against each other. Now, here's the verdict, and it's conditional because the right answer depends on who you are. For first-time home buyers and early career householders in 2026, start with the 30-year. Not because the 30-year is mathematically superior, it often isn't, but because in 2026, with rates at 6.5% and home prices elevated, the payment burden of a 15-year leaves too many households with no cushion. The job loss that hits in year 2, car that needs replacing, the medical bill that lands sideways, these are the moments where the 30 years lower contractual payment becomes the most important number in your life. Take the 30-year, keep your total housing costs, principal, interest, taxes, insurance below 30% of your gross monthly income. That number is not negotiable, and if there's money left after your emergency fund and retirement contributions, consider directing some of it towards extra principal. You get most of the 15-year benefits with the 30 years safety net. Now, for mid-career households with stable income, a funded emergency reserve, and retirement accounts on track, the 15-year is the upgrade. You can handle the payment. The full savings mechanism works in your favor, and a paid-off house before retirement means dramatically less money you need to have saved to live comfortably. The 15-year here isn't just saving interest, it's buying freedom of time. For pre-retirement buyers, align your payoff date with your planned retirement date. That's the rule. If a 15-year gets you to zero before you stop working and you can sustain the payment without sacrificing retirement contributions, it's almost always the right call. The biggest mistake in this entire video isn't choosing 30 over 15 or 15 over 30. It's walking into a lender's office without knowing which one is right for your situation and letting someone else make that interest rate call for you. Now you have the framework, the rest is arithmetic. Now, this video is for educational purposes only. It summarizes what the research shows across multiple financial frameworks. It is not personalized financial advice. Before making decisions of this size, consider consulting a qualified financial planner who can look at your full picture. Results vary significantly based on your income, tax situation, location, and life stage. Now, if you've decided that a 30-year with disciplined extra payments is your path, the next logical question is whether you should direct the extra cash towards the mortgage or invest it instead. That video is here. Thank you for watching this video. If it helped you understand which side of the decision you're on, drop a comment with your age and which way you're leaning. It helps other people watching see where they fit.